Hi, and welcome to our end of May update from the Wealthy Doctor Institute. Intelligent investing for the busy professional. We focus on simple battle-tested methods of investing that require just a few adjustments each year to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to the concepts in this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. So this month, we'll go over the Busy Doctor's update for the month. Then we'll go over the topic of the month. Review our system, starting with the 20-month moving average system, the MRI system, the rules for using a 25% stop loss system for those of you who absolutely positively must buy individual stocks for some reason, monitor the free Sector Surfer strategy that comes with your Sector Surfer subscription. So a lot to cover, let's get started. So day in the life of a busy doctor. So even though I semi-retired 5 years ago, life continues to be busy. And I get questions about, well, why? Well, for one, this past month, this is when my son just finished up his year in middle school, so I'm glad I've been able to be present for this part of his life, even though now he's a teenager and is a little bit more independent. But I've been able to get more time than I would have if I was still in private practice. But yeah, why am I still so busy? And this isn't just me, but if you ask other people who have retired or semi-retired, a lot of times maybe they thought about leisure activities and maybe after a few months they get bored of it. Frankly, because, if we're relatively young and able-bodied, sound of mind, we have a need. We have a need to be useful, productive, either to our family or to some causes or even just working again. This is where we derive a lot of our joys and significance and self-worth. So for those of us who go back to work, or they find another calling, or they find something else interesting to do, we're no longer working for money. And as a result, whatever we're doing, now we're playing at an even higher level because we're just playing full out doing something we're made to do. For instance, Warren Buffett, he's 90 years old, he's still putting in 12-hour days. He's one guy that can retire if he wanted to, and yet this is what he does because this is what he's made of. And yet he still puts in these 12-hour days because this is what he's made for. This is his calling. This is what juices him. And just this past month, I had another colleague tell me that she's going to step down. She doesn't know what to do yet. But yeah, this is one of these things where, we're already fairly driven people to go into med school to begin with. Life happens for us. We will find that calling. We will find that thing that fulfills us. And remember, sometimes the calling whispers. So that's what I say for anyone who's even considering at least semi-retiring. If you can plan for it, just the luxury of being able to do it if you want to is so freeing. And meanwhile, despite the busyness, I still easily place trades indicated by my systems. They literally take mere minutes to see and execute. So that brings us to the topic of the month. Putting investment into perspective. Now, yes, my book is all about how to invest. My videos are all about how to invest. Follow along what I do every month when investing. However, investing isn't your entire financial picture. It's only one element of what I'm going to call the machine. So what do I mean by this? Instead of just looking at investment strategies, we have to look at the goals and needs that you're anticipating. Everyone has different goals and needs. Everyone has different life circumstances. Everyone's different phase in their lives. Everyone has different values. And yet, sometimes life also throws us curveballs. So we're trying to prepare for not just things that we're anticipating, but things that we haven't even considered that suddenly hits us in life. So there will always be unexpected surprises. There's no way we can plan for everything. However, we can do the best that we can to plan for most things and then just go on. Never be afraid to take imperfect action. That's true in investing, that's true in financial planning, that's true in life in general. That's true if you're being an entrepreneur and trying to start up your own business. It's true even in your own careers and your own lives right now. People try to be perfect and don't take any action because they want to line up all the red lights that they turn green first before even starting. That's not going to happen. Life is imperfect. We can take imperfect action and just course correct on our way. So, building the financial plan, the machine that incorporates investing in the plan, might help you get to whichever goals and needs that you're anticipating. So, why invest? What's the purpose of investing? When I give a seminar and I ask this question and I poll the audience, I get all these different answers, all of them well and good, and it all boils down to build an income stream. And that's because there will be a time in your life when you can no longer trade time for money. And to live, we need an income stream, whether or not that's withdrawing from a pile of cash or some other kind of investment or plan that generates income for life. This is the ultimate goal of what we're trying to save and invest for. Anything beyond that is funding our legacy, whether or not it's trying to leave something for a family, for charity. If we'd rather spend more time now pursuing dream activities such as golfing or traveling or whatever, and just whatever you're doing up and beyond income stream is basically your values. And we also need to talk about the 800-pound gorilla in the room, that there will come a time when we can no longer trade time for money. Yes, we have people like Warren Buffett who are still working very hard in their 90s, even though they don't have to. But remember, those are relatively rare. Most of us will get to a point where being free of age, illness, sudden stroke, or whatever, some kind of disability, we will no longer be able to trade time for money. And it's an eventuality that's wiser to consider than disregard. So how many of you remember John F. Kennedy? Well, maybe not remember, but at least heard of him saying that I believe this nation should commit itself to achieving the goal before a decade is out of landing man on the moon and returning him safe to Earth. Well, many people remember the moonshot, getting the man to the moon. But arguably even more important is getting that guy back safely. Well, that's this thing. It's relatively easy to get the man on the moon, but it's a whole new story to add in that getting him back safely to Earth thing. In fact, most of the moonshot program was trying to figure out the second objective of this challenge. So let me just get aside about the moonshot. Most people, when they talk about moonshot, they're talking about, well, yeah, I want to gamble and, see if I can get it. If I do get it, great. If not, then, oh, well, it's a moonshot. Well, in actuality, moonshot isn't a gamble. If anything, it required the coordination of all these different disciplines and different systems and different people working together to get this program solving all these problems so that this program can actually achieve its mission. So it's far from a gamble. This was a very premeditated, meticulous plan and execution of a common worthy goal, which involved several moving parts and systems. So yes, if you think of your own financial planning as a moonshot in this context, yes, it's a moonshot. We have to plan. So what would the machine that might help conquer the mountain of freedom look like? Now, why am I suddenly changing metaphors here? Well, I'd like to reference Tony Robbins' book, Money Master the Game. A couple of reasons. There are many investment books out there. Tony Robbins is someone that is widely read. His book is simple to read. It looks daunting, it looks thick, but actually very quick read. And so if we just look at his book as a source of common reference points, it makes our discussion a lot easier. So in his book, he describes a critical capital mass in terms of a mountain of freedom, where there's an accumulation phase and a deaccumulation phase. So just like the moonshot, it's fairly easy to get our critical capital mass. But if we have to come down safely and live off of this critical capital mass for the rest of our lives, that's a different level of planning that we need to consider. So here's the map. Now we need a vehicle or machine to help us get there before our unspoken deadline. And we only have one shot to get this right, because when we get to that point of our lives where we can no longer trade time for money, whatever critical capital mass we have at that time, that's all we have to work with. We can't always rely on a rich uncle dying and leaving us with a fortune or something. We must make plans. So here's our overall strategy for the money machine. We spend less than we make. We save a percentage of our earnings. That earnings is saved and invested, growing to a point where it's a critical capital mass, to a point where it actually gives us income for life. So of course the question is, how big does this critical capital mass need to be? So that's the question that usually stumps us and seems the most complex to answer, and therefore is the biggest roadblock for many of us from further planning. And in fact, if you go to any financial planning professional, they're going to give you this big spreadsheet-like questionnaire with all these nitpicky answers that they want you to fill in the blanks for to figure out how to plan for your financial future. And it all seems very daunting. But what we can do, and this is one thing I like about Tony's book, is that he breaks it down into chunks. So, keeping in mind that critical capital mass funds income for life, there are various levels of critical capital masses that we can potentially plan for. And Tony labels it financial security, vitality, independence, freedom, financial freedom, absolute financial freedom. And here's what it means. If we were to learn how to shoot a bow and arrow, for instance, we would put a target maybe 10 meters away. If we can hit that, that's a relatively easy target to hit. So we'll call this one our financial security target. Once we hit this target, we can go on to our farther away target, the financial vitality target, twice as far away. If we can hit that, then we can go for a financial independence target, which is even farther. And then we can go for our financial freedom target, which is way out here. I hear most bow and arrows only go 75 meters. So to get this target, we'll have to use a different mechanism, such as a gun or something. And then, of course, if we can hit this financial freedom target and we go for absolute financial freedom, that's our moonshot, 238,000 miles away, which requires a completely different vehicle and strategy to get there. So, here's a machine. It's a 3-bucket system. Now, there are many financial planning books out there. They all have different variations on bucket systems. Some have a 3-bucket system, some have 5-bucket systems. They structure buckets a little bit differently. Again, if we were to at least use one common reference point, and again we'll use Tony's book, it'll make conversations a lot smoother. So, for the 3-bucket system, in this system we have a system where when you have pay yourself first funds, in other words, spend less than you make, nothing works unless you spend less than you make. The first bucket is a security bucket. This is where you put money in for emergencies, for instance, or opportunities, or for fixed short-term goals, such as if you know that you need to replace your roof in 5 years or less, then you would put money into this security bucket using, for instance, bank or insurance or whatever source that either guarantees not to lose money or very hard to lose money. The security bucket is just for that, safe money. Because when you have bucket 2, the growth or risk bucket, this is where you put in stocks or bonds or real estate or, cryptos. I don't recommend cryptos. Artwork, anything that can potentially grow in value, but also has the potential of losing value. That's why we call it the risk bucket, not just the growth bucket, to remind ourselves that if it can lose money, don't put it in the security bucket. Put it in the risk bucket. And then, of course, you have the 3rd bucket, which is the dream bucket. There's an importance to having rewards. So, like, for instance, my own parents, their whole life they were saving and investing, but they never really celebrated their lives, except for maybe a few minor indulgences here and there. Meanwhile, on the other extreme, I know many colleagues who live by the dream bucket, and they hardly ever saved anything in their growth or security buckets except whatever they were forced to by the company 401k plan. So you can see the trouble with living on any extreme. And if you take a look at financial planning, all it is financial life is a balance of these three buckets. Why make money if you can't enjoy it? Yet at the same time, if you make money, make sure that you build your machine to make sure that when you get to a point where you can't trade time for money anymore, you're still okay. So let's take a look at this example. We have twins, Connie and Daphne. They're both ready to retire with $500,000 in their investment account, and they take out 5% the first year, and then every year 3% more after that to index for inflation. They both invest in a stock market that returns an annualized return of 8.03%. However, in these two different universes, Connie's stock market performs this way. Daphne's stock market performs this way. It has the exact same return, only the order is reversed. So you see how Connie lost 10% first year. Over here, Daphne doesn't lose it until year 25. Connie makes 12% last year, but Daphne makes 12% the first year. So if you take a look at Connie, she withdraws money and runs out after 20 years. Whereas Daphne, using the exact same withdrawal strategy, ends up with a lot more at the end than Connie did, and this is a self-sustainable system. Well, what's the difference? Well, the difference is sequence risk. The sequence of returns of the markets makes a huge difference, especially if you suffer losses in the beginning. So what can we do about this? Well, let's take the example now, Connie versus Sally. They're both in the same universe with the same stock market returns, only with Connie, she's taking out money every year and runs out after 20 years. Sally, on the other hand, when there's a market loss, she doesn't take out money that next year. Because remember, when you take money out when the markets go down, you're actually locking in those losses. You're not letting your capital mass heal or recover. So, if you were to just leave your risk bucket alone to recover when it suffers losses, then you can see how Sally becomes self-sustaining over the entire 25-year period that we were observing her. Now, you're probably going, well, look, you're covering like 6 years worth of retirement income. That's huge. Well, that's fair. So why don't we do this? Cover only 3 years worth. So if Sally only covered 3 years worth of market losses with her safety bucket, then she can keep withdrawing at the same rate Connie is, and still at the end of 25 years, still have a substantial amount that will realistically, at this point, last her until the rest of her life, assuming no unexpected life curveballs. So yes, when I get asked how big does these buckets have to be? Well, we'll talk about the risk bucket, but for now, at least we know safety bucket. In the beginning, if you save enough in the bank at least to cover 6 months worth of expenses, that's a good rule of thumb to consider in the beginning. But later on, when your needs become more sophisticated, then consider more sophisticated ways of putting money into your security bucket so that it can cover 3 years worth of retirement income. But then that's it. Then you have your permission slip to keep on concentrating on your growth bucket so you can hit all those different levels of financial security, financial vitality, financial freedom. So great, we have our targets, we have our levels. How do we calculate out the growth bucket portion of our machine now? Well, here are our financial targets. So according to Tony's book, the 10-meter target, which is the financial security target, basic needs, you only have 5 things: housing, utilities, transportation, food, and insurance. These are pretty basic, they're pretty fixed for the most part. If you can have enough of a critical capital mass to just fund these 5 fairly fixed expenses for the rest of your life, that's already one level. And then if you put the target a little bit farther away at 20 meters, your financial vitality target, it's everything in financial security plus half of your current minor indulgences, such as clothing, dining, entertainment. If you can get this, then you can put the target 50 meters away. That's your financial independence goals. That includes your financial security plus basically your current lifestyle costs. So that's including clothing, entertainment, dining, minor indulgences. And then, if you can cover all this, which is basically where a lot of financial planning stops, if you want to go on and target 2 or 3 significant luxuries, which, luxuries in air quotes, because sometimes some of these are dreams for us. Some of us dreams of having an island somewhere. I don't know. Some people dream of being able to fund their own foundation or something, or some people dream of leaving this huge gob of cash for their kids or grandkids or something. Whatever it is, if you add these meaningful luxuries to your target, this will be your financial freedom. Obviously, this one's harder to fulfill unless you've fulfilled up to your financial independence goal. And then, of course, the moonshot target, where you can't really use what we've been getting to financial freedom so far. You need to be a lot more sophisticated to get to your absolute financial freedom, where you can get everything you can possibly want anytime you want. But at least you know that if you plan and execute well, this is a possibility to think about. So here's an example calculation for at least the financial security. Again, you only have 5 categories: your housing, which usually means your rental mortgage, your food, household goes in here, amount per month, your utilities such as your gas, electric, water, phone, that goes into this blank, how much you spend on transportation, go in this blank, insurance payments, go in this blank. You add up your total, that's your monthly total, multiply that by 12, that's your yearly total, and then you take your yearly expenses and multiply by 20, or if you're younger, multiply by 25. That's your critical capital mass for funding these 5 expense categories. And the rationale is, if you multiply by that 20, that means you can withdraw 5% every year using that combination growth safety bucket buffer that I described before to fund these 5 expenses for the rest of your life. Now, if you could just cover these 5 expenses, how would you feel? I would imagine empowered enough to go on to the next level. And if you're younger, you say 25, just so you give yourself a little bit more buffer just in case, because again, the younger you are, the more of a chance that life is going to throw a curveball at you. So paradoxically, when you're younger, we're being a little bit more conservative than if you were older. So, as a summary, to design your machine, it only works if you spend less than you make. Whatever you have left over, you first determine your goal or financial targets. And again, we have those levels of financial targets that you can target. And then determine the elements of each bucket of your machine that can help you get to those targets. And then, after you do all the planning, steps 1 through 3, step 4 is the actual execution. Because balance of your 3 bucket system is the backbone of your financial life. So, having gone over all this, let's start reviewing our systems. So our first system is the 20-month simple moving average system, abbreviated 20-month SMA. The way this works is that if the price of the S&P 500 index fund is above the 20-month moving average, it's relatively safe to stay invested in the index fund, otherwise get out. This 20-month moving average is our safety belt. It only works if we watch it every month. So here's where we are right now. The blue wiggly line is the S&P 500 index mutual fund, dividend corrected. The red line is the 20-month moving average. You can see how the blue line is still above the red line for now. In fact, this month, the VFI Index, which is the Vanguard S&P 500 index fund, the reason I use the Vanguard fund is because it has a lot more data that I can use to calculate these trajectories. It ended with a net asset value of $250.58 per share, which means the moving average was $226.55. Now, just as a quickie exercise, divide, we have a 10.6% cushion. In other words, until next month, if the markets gain, be flat, or even lose up to 10.6%, we're still relatively safe. However, if the markets lose more than 10.6% by the end of next month, then that would trigger that something's going on in the markets. It's starting to become dangerous. Let's get out. But right now, it's saying by this criteria, it's relatively safe to stay in the markets for now. So last time we were looking at how the markets were behaving the last few months. It's been very choppy. In other words, it's gone down, up, very sharply up and down compared to how it was performing the last year, relatively smooth. Well, an interesting pattern that emerged was that you can draw these lines connecting the higher lows and the lower highs, and you see how every time it crashed, it respected this line, crash, respected this line, but then every time it raised, it respected this line. When it gained, it respected this line. When it gained, it respected this line. Eventually, if it bounces around these two lines, it has to violate one or the other line. And whichever line it violates is probably going to be the direction that will take, at least for the short term. And so this was last month, and this is this month. So yes, early on this past month, the markets did go above this line. So if you were a day trader and you noticed this, you could have bought the index as it broke above, and you would have had a chance to sell it at a relatively higher price for a good part of last month. Now you can notice that even though the market shot up a little bit, it's been slowly drifting down ever since. But again, this is only if you are a day trader or somehow interested in looking at daily chart patterns. I would not recommend it, especially if we already have a monthly pattern that works fairly well for our purposes. But at least now we know the markets have violated one of these lines. What does this mean to us? Absolutely nothing, because we use a completely different system that doesn't even look at this. Having said that, here's Sector Surfer's StormGuard Armor version of Bull Bear Market Indicator. Right now, it says that StormGuard Armor is still saying it's relatively safe to be in the markets. However, if you take a look at the actual indicator, it's getting closer and closer still to zero. It's kissing the zero line. It didn't quite cross over yet. So until it crosses over, the StormGuard Armor indicator says it's relatively safe to be in the stock market for now. So we just respect the indicator. Don't jump the gun and think, whoa, it's going to go down, it's going to crash, it's going to cross over very soon, might as well sell out now. No. Wait until it actually gives us a signal and then act on the signal. So our observations for this month, the S&P 500 index did gain for this month, for now. Both the 20-month moving average indicator as well as the StormGuard Armor indicator says it's relatively safe to be in the markets right now. However, again, you visit these signals once a month. In fact, with Sector Surfer, even if you don't, if you set up your account properly, it will text you, it will email you, depending on your preferences, and it's less likely that you would miss a signal. Now remember, none of these systems are designed to catch peaks. By definition, in order for markets to become dangerous, it has to wiggle down enough that it triggers danger zone. So our next system is the monthly rotation investment system, otherwise known as the MRI system. And the system is fairly easy. You only have 3 different mutual funds: the S&P 500 Index Fund, the Emerging Markets Fund, and the Inverse S&P 500 Index Fund. And you just rank them every month, sell the bottom 25% of your portfolio and buy the top fund. Now, here's a question that people ask: do you have to buy and sell these particular funds? And the answer obviously is no, because remember, this is the S&P 500 Index Fund. There are many versions of it depending on which mutual fund company has funds, and they're not necessarily just mutual funds. You can have S&P 500 ETFs, which have lower expense ratios, and you can buy and sell directly on the markets. Same with the emerging markets. Same with the inverse S&P 500 Index Fund. I use these particular 3 funds to calculate because there's a lot more data to use to calculate, but we can always substitute an ETF for any one of these. So this is how the MRI looks this month. Last month's data, this month's data. Divide, and lo and behold, we have a clear winner. This month is the S&P 500 Index Fund. So if you can take a look at the graph, the S&P 500 Index Fund is clearly positive, whereas the inverse fund is clearly negative by definition. But if you take a look at the emerging markets, that's been crashing this month as well. So we sell whatever we have left of the emerging markets, up to 25% of our portfolio. If we don't have enough, then we'll have to sell inverse funds and use those proceeds to buy the S&P 500 Index Fund. So this is how it looks. Last month, we were roughly 50% in the inverse fund, 25% in the index fund, and 25% in the emerging markets. If we were to sell the emerging markets and buy the index fund, then it would look like this. Emerging markets now is this index fund. And if you're thinking that, well, the way the inverse fund works is that if the index fund goes up 1%, the inverse fund must go down 1% and vice versa. That means the index and inverse pretty much cancel each other out, and what we are effectively are in cash for this month. Now, if you take a look at Sector Surfer's version of the MRI funds, Sector Surfer has us still in the emerging markets fund. There's been no signal yet to trade out yet. Again, this is a different system, has a different way of calculating out relative risks and which one we should be in right now. Don't mix up systems. So observations for this month is the US stock market has gained this month while the emerging markets lost ground. As a result, we are rotating into the US stock market. However, since we're 50% index fund and 50% inverse fund, they cancel each other out, so we're basically completely in cash, or at least the equivalent of being completely in cash. Sector Surfer continues to be in emerging markets. That's not a discrepancy, just two different systems working the way they're supposed to. That's why if you're using one system, don't mix up with the other system. Next system is a 25% trailing stop loss system. This system is to be used only if you absolutely positively must buy an individual stock for some strange reason. The reason why I don't advocate that is because stocks themselves have idiosyncratic risk. You can have stock-specific news that tanks that one stock where the rest of the sector may still do well. So here's how 1% trailing stop loss works. If you really want to buy an individual stock, limit your risk to just 1% of your portfolio or trading account. So if you have a 25% trailing stop loss order, you can buy up to 4% of your trading account worth of that one stock. This way, if it drops 25%, you've only lost 25% of 4%, which is 1% of your portfolio before you sell. Now, here's the corollary. If the stock goes up 33%, in fact, if you're expecting stocks to shoot up, and that's the whole reason why you're buying anyway, it does actually shoot up. If it goes up 33%, that means your trailing stop loss just went up to break even, and you can go ahead and use another 4% of your account to buy more of that stock. Just update your trailing stop loss order to reflect the increased number of shares. Rinse, repeat every month until stopped out. So the next system is the Sector Surfer system. In fact, it gives you a free strategy when you open up your free Sector Surfer account. Sector Surfer, as you probably already know, improves on the classical pie chart investing if you structure it correctly. Sector Surfer has two main tools. It has a StormGuard armor, which helps you determine whether or not it's safe or dangerous to be in the stock market, and it has a sector rotation component to optimize your momentum in either component. What you do is, if it's relatively safe to be in stocks, you can rotate through only stock funds, and when it's dangerous to be in stocks, you rotate through non-stock funds, such as bonds. Again, if you set up your Sector Surfer strategy properly, you will get signal through text or email. But me, I like to log on periodically, like once a week, just to make sure I don't lose or not see a trading signal. But that's me. So for this month, the free strategy that comes with Sector Surfer remains in a safer stock zone and has no trade indicated. So here it is. The example free strategy, we're still in the Fidelity Worldwide. So in summary, for this month's video, we've overview the role of investing in our overall financial plan. Remember, investing is not the only component of a financial plan. A brief look at basic technical analysis, in fact, just observing that we've broken out the triangle, says something which may or may not be important, but we'll keep observing anyway, just out of curiosity. Meanwhile, we've gone over our 20-month moving average system, our monthly rotation investment system, dealing with stock tips, and going over the sample-free sector service strategy. So keep those questions coming. I know I've talked to several of you personally every month, and realize that for some of you, these video updates are not enough, especially if you're still unhappy with your current investing system or lack of system. I'm going to offer a complimentary investment wellness checkup and breakthrough session. So during this consultation, together we'll work towards creating that sense of clarity about your financial future, that plan we were talking about, and how various components can fit into that financial future that you really want. Discuss which investing building blocks actually would help in your particular situation. Determine what has stopped you from getting the investment results you wanted in the past, and identify actions you can take that may move you towards the financial goals that you desire. Together, we'll complete the consultation with the excitement of knowing exactly what to do next to create the financial future that you really want. Think CME, only the topic is financial and it's tailored to you. Think wellness checkup, because whether or not you feel financially well, if you had financial cancer or a financial blind spot that you didn't know about, wouldn't you rather at least know so you can deal with it before the problem grows and metastasizes? Don't be bashful reaching out. The more you delay, the more time is against you. So, until next month, invest safely.